Interest rates, we know they influence the strength of the economy, but how much influence do they really have? And is the central bank making the right decision on what those interest rates should be? And what if they didn't keep changing it? What if we just stuck at one rate forever? What would happen then? Hopefully, we'll make interest rates seem interesting. This week on the Debunking Economics podcast with Professor Steve Keen, I'm Phil Dobbie. Welcome along. Well, we know for a while, at least this year, we'll be paying a lot more in interest. The Fed is meeting this week in the United States, the central bank, and there's some speculation that they are going to hike rates as much as 0.5% in March. They're certainly going to raise their rates, and there's going to be many more rates this year, but maybe there's a talk about perhaps they're going to shock the market with a 0.5% rate rise. Canada and the Bank of England will follow suit fairly shortly afterwards. It seems every central bank in the world is doing this, apart from in China, where actually they're going the other way. And the RBA in Australia is being reticent as well, but they'll probably change that when they see inflation start to pick up in Australia. So how important is it? What really determines interest rates? And if you ask most people, they would say, yes, it's the central bank just trying to cool down or heat up the economy. But I wonder if really, Steve, the central banks have got much choice on this. So you told me to read chapter 17 of Keynes's General Theory, where he talks about...
sorry about that.
Well, look, it's a heavy read, isn't it? I have to say.
It is a heavy read,
It makes your book, Debunking Economics, feel like a Mills and Boon novel for, its elegant, simplistic approach.
I'll take it as a compliment until it advise otherwise.
Yeah, until you've read some Mills and Boon. It could destroy your life. But look, I mean, in chapter 17, a few things there, but one is, at the start, he's saying, well, look, everything's got an interest rate. We tend to think, don't we, that, government bonds and therefore government debt has an interest rate, and that's what we're really concerned about. That's what central banks are concerned about. But everything has an interest rate, doesn't it? So if I was going to buy some potatoes in the future, the potatoes future, on the Irish Potatoes Future Exchange, I'm going to pay an interest on that rate, aren't I? Based on what I think potatoes are going to be in a year's time. I'm using today's money to buy something in the future.
Yeah, it's what they call an own rate of return, and that was something Keynes made a fair bit of a song and dance about in that particular chapter, saying that every product has its own rate of return. What we're talking about with an interest rate is trying to get a generic rate of return for an economy as a whole. But he didn't see the rate of interest as having the same determining role in the economy that neoclassical economists ended up having. In that particular chapter, he is talking about how you can vary the rate of interest and you vary the rate of return on capital, whether the rate of return on capital is above the interest rate, which is going to give you a boom, or it's below the interest rate, which is going to slow the economy down. But in the middle of that chapter as well, he started talking in terms of something completely different, and that most people miss it. And that is, he's saying that investors will buy a capital good if they believe they'll make capital goods, make investment goods, if they believe that the sale price, or what he called the demand price of the good, will be greater than the supply price or the cost price of building it. And by the time it gets to the 1937, the stuff about the rate of interest fine-tuning the economy has almost disappeared. And what he says instead is that people's expectations of future profit are what determine how much they're willing to invest. And that depends on the gap between the supply price and the demand price for an investment good, which was not something he had in the general theory itself. And that then downplays the role of the rate of interest, because the idea of the sort of reaching an equilibrium was partly the idea in chapter 17. But here he's got a gap between the supply price and the demand price, and the bigger the gap, as it's perceived, the higher a rate of return you expect to get, and therefore the less you're going to be worried about the rate of interest you pay if you expect a higher return coming out of the capital gain you expect.
But that applies to anything, doesn't it? So if there's going to be a lot of potatoes this time next year, and I can read tea leaves and know that in advance, then I know the price is going to be lower. And similarly, oil futures, computers, furnitures, whatever you want, it's your perception of the future demand and supply which is determining that price, isn't it? It makes no difference whether we're talking about money or we're talking about commodities. People are speculating on all of them, and they all have that assumed rate of return based on what your perception is of what future demand and supply is going to be.
Yeah, but the rate of return is no longer what Keynes called in the general theory the marginal efficiency of capital, because its whole idea about marginal implies a small change. You can make a small change in the rate of return on something. That's the whole idea of a marginal change. But when he starts talking about the supply price and demand price, he's talking about a gap, and the gap exists because your expectations of the future are uncertain. You don't know what's going to happen in the future, but if you speculate that a particular commodity is going to do very well, or that a particular industry will do very well, or that the economy itself will do very well, then you will be willing to you pay a very large rate of interest to be able to get your hands on money, which enables you to invest in that line of business. And therefore, the capacity, the rate of interest to fine-tune everything, which comes out of the idea of the marginal efficiency of capital, that starts to go by the wayside.
Yeah, particularly if you start to look at herd impact, sort of animal spirits. If somebody speculates that something is going in one direction and everyone goes, oh, he might have a point, and everyone jumps on it, then that future is sort of determined, isn't it? And everyone might lose out as a result of it if he's made the wrong call. But the price of commodities is very little to do, I suspect, with the supply and demand. Well, it's a part of it, but it's largely the future price or the future perception is driven by the way the market's driving.
And you get a great deal of volatility out of that, and volatility that you can't control by fine-tuning the rate of interest. So having started off by talking in terms of in the general theory about controlling the marginal efficiency of investment by varying the rate of interest, by the time he gets to 37, he's starting talking in terms of the sort of thing you're talking about, the herd mentality, people... Your speculations about the future are based on very fragile information. And he said you really shouldn't be... You're determining your behaviour now based on your expectations of the future, when your knowledge about the future is incredibly uncertain. So what you tend to do is project forward what's happening at the moment, even though when you're looking at the past, you know that extrapolating forward from what's happening now has always been a bad guide to the future. So in the middle of all that, you don't exactly get a picture of an economy that you can easily fine-tune by changing the rate of interest. But that's, of course, what the neoclassicals have got into in their world, where they try to eliminate expectations by saying we all have rational expectations, and those rational expectations are accurate predictions of the model of the economy that neoclassical economists happen to have. So they've ended up neutralizing the importance of expectations as Keynes saw it, and therefore that leaves the whole burden in their minds on adjusting the economy, on varying the rate of interest.
But we can have expectations on all of these different things. What the return's going to be on potatoes or oil or computers or furniture or T-shirts with Steve Keen's face on them. But if all of those, if everyone is perceiving that all of them are going to increase in value, then doesn't that mean that somewhere written into that there's a perception of a base level of interest, which the central bank perhaps does need to pay attention to?
That is an idea that economics keeps on coming back to in various ways, because it was the economists are seduced by the idea that there's some natural rate of everything. The idea that there's a natural centre of gravitation is something which is very seductive to the neoclassical vision of how the economy operates, and they've turned that into part of their model of how the central bank should control the economy, trying to, since they're the supposed experts on the economy, they can work out the rate of interest that will fine-tune the rate of inflation to reach this target set of numbers they have of a rate of inflation of about 2%, a rate of growth of about 3%, and a rate of interest of about 4%.
So, and all of this came from Hicks's work, didn't it? From his ISLM model. So tell us all about that, how that works.
Okay, well, the concept starts off, first of all, the idea that there's a fixed money supply that the government can vary. That's when you look at where Hicks derived it, he has this idea of a vertical money supply curve. And if you that's the supply of money. The government can move it one way or the other. So it sees the money supply as being under government control, which of course is not the modern attitude that the market itself sets the amount of money.
Well, that's not a good start, is it, when the central premise is actually wrong? But we'll look at that in more detail, the Hicks model, but also the more fundamental question. What if central banks didn't change interest rates? What if we just stuck with one interest rate? What implications would that have? We'll look at that in the full version of this podcast. To hear it in full, you need to become a subscriber at debunkingeconomics.com or become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof. Steve Keen. That's it for this week. Catch you again next week. Thanks for listening.